Climbing the wall of worry is a popular investment phrase coined from the sentiment used when analyzing the S&P 500 index. As it hits an all-time high, especially after a prior 20% plus correction, followed by one of the fastest recoveries, the rally becomes the most hated. Institutional investment on the sidelines want lower prices before positioning, the dips become shallow and the S&P climbs to new all-time high after new all-time high. This happened 57 times in 2024. The fear wasn't bought, so do you now buy the breakouts? The financial conditions look good towards the end of the year, with rate cuts, ISM still yet to get past 50, tariff income, Trump desperate for growth to ensure victory in the midterm congressional seats. The wall of worry continues to climb, and the correction that most people hope for may not arrive. S&P trading at 22x multiple of earnings is close to the highest ever, usually a bad sign as it means overvaluation of companies on average. However, the nuance and the caveat in this particular concern of 22x multiple, which is very high and means overvaluation, is the 7 biggest companies in the S&P 500 that make up the 38% of the weight of the S&P 500 haven't given guidance on their projected earnings. And so if their projected earnings going into the rest of this year and into 2026 is positive, it means that there's going to be more space made available for the S&P 500 to continue to climb that wall of worry. In this video, I want to look at the most popular macro trends and graphs that frame how I look at the markets and what I believe. So in this video, I'm going to examine the M2 money supply and how the easily available cash leads to growth assets being impacted the most, the decreasing demographics, which means that there's going to be more government intervention and central bank intervention monetarily, especially with the easing of the monetary policy, and then the ISM, and how that has an impact on the risk curve. I want to finish off with how M2 money supply can proportionally impact different asset classes and just some of the graphs and the data that I've managed to collect. So if you're interested in economics, you're interested in macro trends, like, comment, subscribe, let's go. To paint a really clear macro picture, you need to understand the first element of this, which is the demographics and how AI could impact this in a positive and a negative way. When you have a decreasing demographics, you have a decreasing labor workforce, you have decreasing economic ingenuity, you have decreasing enterprise, less goods and services being produced for the gross domestic product of a country. When you have this, you have a central bank that has to inject and intervene. They have to stimulate, they have to lower interest rates, have to make money easier to borrow. And so all of this just leads to inflation in risk assets. It leads to inflation in assets across the board, as there's now more money chasing fewer products and there's more money chasing fewer assets. So this first picture looks at some of the problems that are going to arise at the back end of this decade. As you can see, there are more layoffs. Large companies like Microsoft and Google and PwC, big accounting company, HP, Dell, they're laying off tens of thousands of new workers. This is going to be massively deflationary, especially as these companies grow. They're going to be able to get their workforce from potentially AI agents and a lot more sophisticated software as it's developed. The next thing is just this demographics, countries with the most seniors. You can see here that you've got countries like Japan, you've got countries like Italy, you've got countries like Germany and France and Spain and Poland. And as this senior demographic grows, the productivity within a country is going to shrink, which means that there's going to be more intervention from the central banks to artificially increase GDP. So in this first graph, you can see that there's a real GDP year over year in the US is just decreasing. The trend is going down. So the actual real productivity that comes from the demographics within that country is starting to shrink, which means there's going to be an increasing intervention from central banks. The working age population in the US is decreasing. It's trending downwards. The US birth rate per 1,000 people is also trending downwards. The US labor force participation rate alongside the birth rate is also trending downwards. And this is a 14-year lead. What all of this means for understanding the markets is that there's going to be a central bank injection of liquidity. Money is going to be easier to borrow. Bonds are going to be bought from the central bank, which means that there's going to be an accounting entry of liquidity into the commercial banks. All of this just means that risk assets will be the ones that are bid up the most as a result of this increase in easy cash Section 2, to build again this macro picture of where markets will trend generally going into the back end of this decade. M2 money supply is the ease at which cash can be taken out of an account and accessed by the public. So the growth in M2 money supply leads to a growth in assets. And you can actually see how it correlates. It correlates to the Bitcoin price almost perfectly with a 8 to 12 week lag. So I'm just going to go through these graphs, which shows just again how important it is to understand that M2 money supply is increasing. Total liquidity annualized is growing year over year. The total liquidity index, it doesn't deviate past this green line. So it goes 2 standard deviations from the red line. And when it gets to that green line, it usually bounces off and then trends up, goes to the top green line, and then mean reverts. You can see that the total debt is trending up. So as the central bank have to intervene, as the debt ceiling is raised by the central government, you'll see that is just trending up and it's going to continue. So as that trends up, there's going to be more M2 money supply. There's going to be more printing. There's going to be more central bank intervention. The US total private debt as a percentage of GDP is flat over the last 20 years. And I think that this is just an indicator that shows that the majority of the debt that's being taken out is coming from the central bank. It's not being borrowed privately as much by corporations anymore. Fed net liquidity, again, follows government debt as a percentage of GDP. So again, this is the additional M2 money supply in the system, and it's just following the government debt. Fed net liquidity and the federal government current expenditures, the interest payments, and this is a 30-month lead. And you can see, again, that's trending upwards. It's not really difficult to understand that if this Fed net liquidity, which is the excess amount of cash in the system, it's trending towards the federal government expenditures. And if those federal government expenditures continue to go up, that Fed net liquidity looks to also follow that trend as well. The last one is the US total liquidity and the federal government current expenditures. Again, as the interest rates start to increase, the interest payments on the debt that the US government are taking out, as that increases, so will the Fed net liquidity, because the only way to pay back the debt is to take out more. The only way to pay back a credit card if you don't have an income is to take out another credit card that has more favorable interest rates to pay back the current credit card, and that spiral just continues. So where does this lead? It leads to all hard assets that cannot be inflated in terms of their supply growing nominally based on the amount of currency in the system. And as that M2 money supply grows, all assets will grow as well. And if you correlate M2 money supply with the growth of every asset from real estate to commodities to stocks and equities, they all grow at the same rate as M2 money supply. I feel like the only thing to do is to just continue to buy assets that you believe in, that you believe have hardness. So this is how M2 money supply impacts Bitcoin. By 83.2%, there's an alignment with global liquidity and the Bitcoin price increase. The same with the S&P at 81%, all the way down to gold at 68%. You can see here, these assets, they all absorb the global liquidity as it increases. The weekly global liquidity index, again, trends and correlates almost perfectly to the S&P 500. It does deviate at times and diverge, but the trend is the same, and it's the direction that you want to really focus on over the long term. That forward PE is the future earnings of the average 500 companies in the S&P 500. That's trending higher. Bitcoin is going to deviate as a result of the M2 money supply. As that increases, the hardness of Bitcoin increases. It's going to trend on this power law logarithmic scale graph. It's going to trend higher and go across that red line and then deviate by 2 standard deviations to the green. Will it happen next month or 2 months from now or by the end of the year? I'm not sure. But directionally, this is what I believe. And this is what I focus on. It keeps the signal clear rather than the noise of the day-to-day headline and the day-to-day fear and the day-to-day liquidity hunting that comes from the centralized exchanges. You can just focus on the general trend. And that deviation is going to continue to happen over an undefined amount of time into the future. The NASDAQ, again, has, because of global liquidity, it deviates to that green line by 2 standard deviations, and then it goes above the red line by 2 standard deviations. And these deviations just give you an indication of the fact that as money supply grows, demographics decrease, and therefore there's more central bank intervention. It's going to lead to these assets all growing as well. And the final one is this. You can see how closely correlated the NASDAQ and the global total liquidity is. They are basically the same. So if you know that liquidity is going to continue to increase, you know that the NASDAQ is going to correlate that almost perfectly. The ISM acts as the canary in the mine. The canary in the mine is the miners in the past would take a canary down, and that canary would be able to sense any solvents in the air that are dangerous, and the canary would then react to that, and that would lead to the miners being able to get out before they inhale any of these dangerous fumes, any of these dangerous toxins. The canary in the mine for the markets, for me, is the ISM. And as that ISM trends higher, all risk assets also trend higher as well. As global financial conditions improve by 9 months into the future, the ISM also follows that. And when the ISM grows and it expands past 50, this is where you have Bitcoin take on its most parabolic move. And we're not yet at 50. We're close and we're trending higher, but until we get past that 50 mark, which shows expansion across those manufacturing companies, we don't have the real expansion of Bitcoin, and we do not have the real expansion of altcoins, which are the riskiest crypto assets on the curve of crypto. So could it be relevant? There are 4 analysts that I like to follow when it comes to understanding the macro bigger picture. Raoul Pal, Julian Bittel, James E. Thorne, and then Cern Basher. And they all share different caveats and nuances that paint a directional picture of the wall of worry being, as you hit all-time highs, there is this fear that you aren't going to have those pullbacks. And as we climb higher, the evaluations start to get to the point where it feels overvaluated. You start to worry. You climb the wall of worry. Now, the 57 times that the S&P hit an all-time high last year, there was going to be a wall of worry every single time, every single milestone. And so I feel that the macro picture, based on the central banks having to inject liquidity for structural reasons, being a very clear direction for me to follow and a signal for me to follow. And if I'm wrong, I'm wrong, but it's the data that I like to focus on. It's the data that shows me that there is only one direction, there is only one solution for the problems that we currently have. And that leads to these 2 potential results, which are the famous banana zone, which is where the parabolic period of particularly the crypto market cap starts to take off. And then you also have Bitcoin's parabolic moment. So we will see. The stock market is not the economy. It doesn't really paint a picture of what the majority of people are experiencing. So if you got any value from this video, it's helped you understand the direction that the markets could potentially go in and why. Like, comment, subscribe, and I'll see you in the next one. Thank you very much.